Okay, we are now recording fully. We are now streaming on YouTube. Welcome, everybody, to GAR Capital's Investing Town Hall. I am your host, Carlos Garcia. I'm the founder and CEO of GAR Capital. Thanks so much for stopping by. For the next 60 minutes, we're going to talk investing and investing only. So no questions about crypto, no questions about options, no questions about day trading. This is just investing and long-term wealth building. So welcome again. So let's do this. Let's begin. For our 8 viewers, welcome again. So the first thing I want to talk about, guys, as you know, first thing I'm going to go ahead is bring up TD Ameritrade. So this is a brokerage account, obviously, right? This is basically what you look at if you want to invest, or this is just a broker, how you buy stocks, how you buy whatever, how you buy bonds, stocks, ETFs, mutual funds, whatever. So the first thing you're probably saying to yourself is, Carlos, how do I build wealth? Well, right now I'm going to Morningstar. Morningstar is probably the Wall Street Journal equivalent or research equivalent for mutual funds. This is how you research mutual funds. Now you're probably saying to yourself, what the heck is a mutual fund? Now I'm going to go ahead and bring up my YouTube group here. See if I can bring up my other window. Here we go. Bring up the other window here. Guys, if you have any questions, please type in the chat box. Any questions? I'm going to type it again here. And of course, I am so slow here. Any questions, guys, if you can hear me, type in the chat box any questions you guys may have. And I can't type for some reason. If you can hear me, please say I can hear you on the live chat, please. Type away I can hear you on the live chat so I know you can hear me. Okay, you can hear me. And for some reason, I can't type anything. So bear with me, guys. You can hear me, perfect. Having little issues here. I just want to type. Here we go, perfect. Okay, you can hear me. Okay, guys, back to it. Just want to let you guys know that if you have any questions, type any questions you may have here. All right, so back at it. All right, so you can see my screen. Let's go ahead back to it. Apologize for the delay. Okay, so Morningstar is basically the research area for mutual funds. Now you're probably asking yourself, Carlos, what is a mutual fund? Mutual fund is a pool of investor money to buy certain stocks. So instead of buying just one share of Google, which will cost you $1,000, you can buy into a pool of investments, whether it be stocks, bonds, what have you, and that will become a mutual fund and be mutually holding. So you'll be buying shares, quote unquote, into that mutual fund so you can have diversity, meaning the numerous number of stocks. Now, different mutual funds have different ratings, meaning ratings of safety, ratings of return, and also expenses. Just give you a heads up. It's not free. Some are free. There's free mutual funds. Yes, there is. And there's ones that cost. We call those load mutual funds. Load meaning the charge. So we're going to talk here as if you have a 401k retirement plan, and if you have a retirement plan, a brokerage account, we're just going to assume that you do. And you're going to assume exactly how it works. So I'm going to be here, and I want to go ahead and hear from you guys. Let me bring this up here on the side so at least I could see the questions. Okay, so as you can see here, we have our Morningstar ready to rock. Now you're probably saying to yourself, okay, so I kind of know what a mutual fund is. I know how it works. So mutual funds, I would say, is a lot safer than just buying stocks, because stocks are just individual stocks. It's just you're putting your money into just one stock or two stocks. So it's kind of not giving you diversification that you would get from a mutual fund. So with that being said, let's look at mutual funds. And here you'll get actual ratings top to bottom on which has been performing the best compared to the market. So let's see what we have here. Long-term managers, fund family research data. So let's see Morningstar medalists, quote unquote. These are probably the ones that are the best ones. Now this one you have to choose, you have to pay for the premium package. We're not going to do all that. So don't worry about it. Let's take a look at Fund Quick Rank. That'd be a good one to start. This will rank all the funds based on return. And of course it's, okay, this is not working. How about, oh, this is plus. That makes sense. Let's see if we could find some mutual funds. Let's find this one here. The Fidelity Contra Fund. So we're going to click on it, and this is the symbol, FCNTX, as you could see. Remember, this is purely based on long-term growth. So here's the stock price, quote unquote, the price, share price for the mutual fund, 132.47. It is up 1% of the day. It's the total assets of this mutual fund is $123 billion. The expense ratio is 0.6%. What does that mean? Means that every year you're going to pay 0.68% to the mutual fund manager for them managing your money. So win or lose, you're going to pay that, which is the fee level is actually pretty low, below average, pretty good. Turnover, meaning how many people leave the fund, and the minimum investment, $2,500. Current status, open for new money. Since 2008, their growth of $10,000, right? This is the blue line, XNAS. Oh, excuse me. This is FCNTX, excuse me. I don't know what XNAS is. FCNTX in 10 years. Remember, 2018, $28,262. It has actually beat the stock market. If you were just bought regular S&P 500 fund, which is, I always tell you is the SPY, if you would have bought this mutual fund 10 years ago, which is in 2008, which is actually near the financial crisis, by the way, look how low it got. We got as low here as 6,150. Now, this is a perfect example of how a mutual fund works and how patience works, guys. As you know, I'm always talking about patience. Patience and discipline are the key to wealth building. You want to be rich? You obviously came to the right place because this is what we're talking about. So the inception of this, 2008, we were up here. Look at this chart here. 2008, you put $10,000 in this mutual fund in 2008. Right around 2009, during the height of the mortgage crisis and all the crap that was going on, you lost 40% of your money. You were down 40%. If you panicked here, look what you missed out on. You went from this 40% down. It took 2 years to get back to the point of where you made money, about 2 years, 2011, and then we skyrocketed. Look how much the return has been. From 10,000 to 28,000, 262. Now, I'm going to go ahead and be lazy and bring that up, the calculator. $10,000 to 28,262. Congratulations, you made 182% on your money in 10 years. I'm going to repeat that one more time. That is $182, 2% in 10 years. That is pretty great. Not only have you beat inflation, which is the main driver, your expenses were really low, and you were patient. Look at this. You were basically in stocks, which was great. 10 years it took you, and you beat the market by $1,000. Well, yeah, you beat the market by $2,000, which is great. So look how much of the growth is. In 1 month, 6.5%. 1 year, 37%. In 3 years, 16.6%. 5 years, 17%. In 10 years, 10.95%. The growth as it pertains from 10,000 to 28,000. Pretty great, huh? Now we're going to look here at what it holds. Now you want to see, what does this fund hold? 7% of the fund is Facebook stock. Facebook today alone is up 2.25%. 5% of the mutual fund is Berkshire Hathaway. Now, Berkshire Hathaway is the company that Warren Buffett runs. Very diversified, Geico, Heinz, whatever. Amazon.com, of course, 5% of their holdings is Amazon. Alphabet, Google, 3.48%, and Apple, 3.42%. So 24% of their assets are locked into these 5 stocks. Now, you could probably think that's pretty heavy, but again, look at the growth that you've had. So they have held technology stocks. 31% is in technology, 13% in financial services, 16% in consumer cyclical, 14% in healthcare, and almost 10% in industrials. That's what the fund's holding. So you definitely want to read these. So these are large cap growth stock mutual fund. So you could see here the asset allocation: 2% in cash, 88% in stocks, 7% in non-US stocks, and 1% in other. And they barely hold any bonds. Now, what you can do before you invest is you want to make sure that you have a prospectus. A prospectus will tell you exactly what they're holding, what their goals are for the mutual fund. So you can see here, one thing I want you to take away from this today, guys, is mutual fund investing, long-term wealth building. From $10,000 investment, remember we fell 40% in 2009, got back up to break even. It took us 2 years of patience to get there, and now we're up 182%. The math is there, guys. I want to let that sink in here. It's not day trading. This is just buying mutual funds. That's it. That's it. Pretty good stuff, huh? Look at the risk versus category. Low risk, giant cap stocks, 88% is in stocks, and they even average below average. Pretty cool, huh? So again, this is FCNTX. You can go here and type in FCNTX, the Contra fund, and you'll get the exact same thing you'll see on Morningstar here on Mutual Funds Profile. And you could buy right here. Press buy and you're good. And it's a no-load mutual fund. Premier list. Look at the annual return. 32% in 1 year, year to date. Below average risk, above average high return. Isn't that what everyone wants? Compared to the S&P 500, it has beat the S&P 500. And here on TD Ameritrade, you can open an account and see all this information. It's available for you guys. You could see it. This is considered a 4-star rated fund, according to Morningstar. So you definitely get a lot more information here. Top 10 holdings. Look, Salesforce.com, Visa, United, Microsoft, Apple, Amazon. Great stuff. Now we get a sector breakdown. Basic materials, consumer cyclical, financial services, real estate, defensive, everything. So let's close out Morningstar and look at TD Ameritrade. So let's say you have TD Ameritrade now. We looked at the first mutual fund and we picked a good one, the Fidelity Contra fund. Pretty cool, huh? You see exactly what you're holding, and we've already talked about in 5 years how much this has gone up. In 2009, it gave us that perspective of exactly how it worked. So I'm going to build up Morningstar again. I apologize for closing it out, but I get a better sense of a chart on there for the mutual fund. I'd rather have that. I really don't see it on a long-term chart on TD Ameritrade, even though I could probably bring that up on my broker. But again, just make it easier for everybody. So I'm going to take a second and take some questions. Can you buy Fidelity or Vanguard mutual funds at any broker? Yes, George, you can. You can go to any mutual fund broker. You can go to any broker and buy any mutual fund you would want. Again, it comes with a ticker symbol just like any other stock would. So again, these are the things that you need to understand. Long-term growth. Yes, we are in a bull market, but look how much patience you had to have in the 2 years that you were there from 2008 to 2009, 2010, 2011. It took 2 years from the bottom of 2009 to get back up to break even, and then now you went above 182%. Very cool stuff, huh? So I'm going to pause for about a minute and see if there's anyone else have any questions. Give everyone about a minute to let that sink in. Okay, so we're going to move on now to, let's take a look at ETFs. So that was mutual funds. ETFs are exchange traded funds. So it's the whole deal. So let's go to commission-free ETFs because we're all cheap and we want to make sure that we get the best deal for our money. So again, guys, you can go to TD Ameritrade, open a free account, and you could see this. These are free ETFs, meaning you do not pay a commission. Commission-free ETFs. Very cool stuff. So here, we're down this list here. They work with Morningstar, number one, good check mark. And number two, we could take a look at their gross expense ratio. We could look at their net expense ratio. We could look at their rating, their category, based on however you want. So let's be, judgmental and look at ratings. So we have 5 stars, 5 stars, 5 stars, 5 stars. So it's really up to you what you want to invest in. So let's go ahead and take a look. Oh, the minimum on that one, John, is 2,500. What is a high fee for your mutual fund? I'm going to answer this question here. High fee for your mutual fund. High fee, anything above 1.5%. Okay, so I got some really good question here. So I got the question here from John. John asked, from Jorge. Jorge, how much of your portfolio would you put in mutual funds? That's a really good question. And that's something that you need to ask yourself because there's a lot of things, a lot of factors. Number one, your age. I always tell people, what's your age? 100 minus your age. If you are 30, right, minus 100, that gives you 60. Minus 170, 70. So I would say you need to be 70% middle of the road, 30% conservative. So, 70% aggressive, 30% conservative. So whatever your age is, you need to be conservative. So if you're in your higher age, I totally messed it up. Let's do this again. 100 minus your age. Whatever your age is, that's how much your portfolio should be conservative, meaning bonds or high cap stocks. The rest should be a little more aggressive into other stocks. So if you say, what's conservative, Carlos? What do you consider conservative? I would say conservative would be precious metals, gold, commodities, treasuries, and bonds. Just a heads up. So those are some of the things that you want to look at. So I'm going to say I'm 30. Let's say I'm 35. I'm not 35. Let's say I'm 35 years. Well, let's say I'm 40. I'm 40 years old, and I say, Carlos, what should I buy? You're 40 years old. 40% of your portfolio should be conservative to asset preservation. 60% should be aggressive. Stocks, mutual funds. So that's how you should see it. Remember, always think that. Kim, what would you recommend for a long-term investment? I'm 18 years old right now. Long-term investment for you, Kim, keep it simple. Depending on how old you are, buy an S&P 500 fund, SPY. Jorge, do you think this bull market is getting close to a correction bear sentiment? As of right now, no. I wouldn't want you to keep saying it's going to end, and you're going to miss the bull market. So we're going to go ahead and continue, guys. So we're now back on TD Ameritrade, and I want you to take a look at always commission-free ETFs because I want you to look at free first. Free first. Remember those 2 Fs. Free first. Don't pay fees if you don't have to. So let's take a look here. I'm going to just choose. I'm going to go and choose the Dow Jones First Internet Index Fund. Looks pretty great. So let's go ahead and click on FDN. This is a 5-star fund. All right, so we're back here on FDN. This is a free ETF, and this is a 1 year in comparison to the Dow Jones, the S&P 500. Wow, big moves. Excellent. So this is available commission-free. This is a 5-star fund. We can take a look at the prospectus if you want. Higher risk, if you definitely want to get into it. It's a little higher risk, but look at the returns. The returns are great. So let's take a look at market return as of 12/31/17, which was about last month. 10 years, 15%. 5 years, 23%. 1 year has returned 37%. Year to date is up 37%. That's pretty great. Look at the ratings here. The street, buy. Market edge, long. Market weight rating, very strong. Let's look at expense ratio, 0.54. What have I said? 1.5%. Stick to lower than 1.5%. I don't want you guys to pay fees if you don't have to, or high fees. Look at performance here. Let's take a look. The growth of $10,000 since 5 years ago. If you bought this stock, this ETF, you are up over 150%. That's pretty great. That growth in 10 years. That's really, really great. Look at the growth of $10,000. You see it right here, guys. The worst 3-month period was 39%. Worst quarter. Best quarter, 35%. So let's take a look at what's in the portfolio. You want to see what the hell they have, right? Again, look at the name. Dow Jones Internet Index Fund. So what do you think they're going to have? Internet stocks, am I correct? Amazon, Facebook, Netflix, PayPal, Google, Salesforce, eBay, Twitter, Expedia. First of all, these are all great stocks, by the way. And of course, everything comes with risk. But again, they're very heavy tech, so you're going to get a higher rate of return as long as tech goes up. Again, this can be a little too concentrated for you. You want to be definitely diversified. So again, if you're into internet stocks and you're very bullish on internet stocks and you want to buy an ETF like this, by all means, do your information, do your research. This would probably be a good one for you. Because based on your sentiment of internet stocks, like us, we do think internet stocks do have a lot more to go, like an Amazon, like a Netflix, like a technology, like a PayPal, like a Google, like an eBay, Twitter. We're long on those. We like those. So again, price to earnings, 29.4. Price to cash flow, 1985. Dividend yields is very weak. You're not going to get dividend yields on internet stocks because they don't pay dividends because they don't pay their investments, meaning their returns. They'd rather reinvest in the company than just pay out shareholders, which I'm okay with because I can get growth. So let's go ahead and go back to questions here. Mo Salman, do you have any advice on how to become a day trader like you? Mo, this is not the video to answer that. This is long-term investing. What is this platform? Sam B says. This is TD Ameritrade. TD Ameritrade. You can open a free account, tdameritrade.com. Take a look. How is an ETF different from a mutual fund? An ETF is an exchange-traded fund, a mixture of stocks, just stocks, depending on, let's just say stocks, a stock ETF. There's no manager. It's just a pool of stocks. Mutual fund has a manager, and they adjust as they go. So that's the main difference. ETFs tend to be commission-free. Mutual funds tend to have commissions. So look at the difference. You're paying for a manager for a mutual fund. ETF, you're basically not paying much. Think of it as a stock collective together. That's number one, and that's the main difference. Okay, so let's go back to looking at mutual funds, ETFs. So we looked at that one, which was pretty nice. So again, guys, if you want to take a look at them, FDN was that first one. So now let's go ahead and talk about what I like. I personally am a dividend whore, as you know. I love me some dividends. So let's take a look at dividend funds. Let's take a look at a global high-end dividend fund, DEW. Again, 1 star, I know. Let's take a look at this. DEW. Okay, so Wisdom Tree Global High Dividend Fund, commission free. Now it's at $50, right? So let's take a look at this compared to the S&P. S&P is actually doing better than them. So there you go. But again, you're giving us a difference here. Dividends versus growth. Remember, a company that gives a high dividend, they're not investing in their company. So you're not going to get high growth, more like your utilities and banks. Higher growth companies like a tech, they're not going to pay dividends and they're not going to buy back their stock. So again, it's really up to you, the investor, on what your goals are. You want to make sure and take a look at those two before you make that decision. Let's go back to the questions. How do you feel about Robinhood platforming, using your service as a reference investing from a beginner standpoint? Mark, I'm okay with Robinhood. I just don't have Robinhood. So I'm just giving you an example of TD Ameritrade. Robinhood, I'm totally okay with. ETF riskier than a mutual fund, I suppose. I wouldn't say riskier. You just don't have a manager. John says, Carlos, can you just discuss index funds versus managed funds? Absolutely. Index funds, consider that ETF. then or index fund would be S&P 500, Dow Jones, or NASDAQ that has no manager, usually commission free or very low commission. Managed funds, again, you have somebody that's working on that constantly. You have a professional that's doing asset allocation. He's buying stocks and selling stocks according to market movement, whether he's buying more or selling more. So again, do you want to pay for a professional help, or do you just want to go with the market? Market's cheaper, but they could be a little more risky. Managed funds, less risky because there's a manager, but he's going to charge you. So again, it's kind of hard to have it both ways. Take a look at that before you make a decision. What is the annual percentage I should strive for my portfolio? 67% after tax. Remember, inflation is running at 3%, so you always want to strive to beat inflation. Inflation is the baseline of beating. So you want your money to have a higher buying power than you would if you put it in the bank. So let's say 3% is the baseline. So 67% year on year, 8 to 10% I would say is the best. 6 to 7% is pretty conservative. I don't mind that. In this bull market, you should be able to beat 6 to 7% with your eyes closed. I mean, our mutual fund alone is up 36% for the year. Our hedge fund. So again, that's a lot more speculative stocks, futures, commodities. It's not an ETF. It's not a mutual fund. Carl just got in. Are ETFs a major part of your portfolio for my retirement? Absolutely, because I leave it on autopilot. When it comes to longer term investments, ETFs are my favorite. I love ETFs because it's autopilot. It's stocks that I know, it's names that I know, it's good asset allocation, and it's no commission. So I can get in and I get out and not get charged. And I can always buy more using dollar cost averaging. Let's go ahead and talk about that next. Dollar cost averaging. Let's do a dollar cost averaging calculator. So here's the dollar cost averaging. If you want to take a look at this is called buy upside. So let's do this one. This one is the Wisdom Tree High Global Dividend Fund, blah, blah. Let's do DEW, right? We put initial investment of 10,000 and recurring investment type, we're going to add $200 a month for every month. And we're going to start January 2018. And we're going to have a time horizon of 10 years, 2028. So I want you to see this. This here, guys, is the key to building wealth. If there's anything I could teach you today, it is this. This is the key. You want to get rich, this is how you do it. This is how you do it right here. I'm going to give you the calculation. DEW is the fund, the whatever it's called, the Wisdom Tree Global High Dividend Fund. We put $10,000 in. Watch this. We're going to pay $200 into it every single month. Every month, $200. $200 every month. So imagine not having a car payment. Instead of a car, you put $200 into this. Starting January 2018, ending 2028. Let's calculate it. Okay, that symbol doesn't come up. Let's put it as AT&T. Just bear with me, guys. AT&T. AT&T pays a dividend too, so I like AT&T. I own it. Dollar cost average results. What? Okay, let me try this again, guys. Bear with me. T. Eek. Let's see if this works now. You have indirect. Why is this not working with me? This is always fun. Okay. AAPL, Apple, whatever. Okay, see. Let's try this again. I'm going to restart this as we go. Oh man, that's embarrassing. Didn't even work. Let's do calculators again. Dollar cost average. Remember the website Buy Upside? I apologize, guys. I don't know what's going on. I've done this so many times. This calculator, now it doesn't want to work for me. Of course it does. Okay, we're back. Quick investment. Let's do $10,000 of Apple, $1,000 a month, starting 2018. and ending in 2028. Let's say I don't want to have a car payment. We'll invest $200 a month into Apple every month, which is about one share a month. We're a little over one share, a little over one share a month. Calculate results. Are you kidding me? You have entered an unvalid, unsupported symbol. What did I do? Let's let's try a different time. Let's put 2010 to 2018. Maybe that's what it is. I think it's just timing. My apologies. There we go. Now it works. It was a timing. My apologies. Okay, so the stock is Apple. Just bear with me here. You bought $10,000 worth of Apple. This is the creative building wealth, guys. $200 you added, right? $200 a month, 1 month. Initial investment number of shares. You had 406, 95 recurring investments. Total recurring investment amount, you added 19,000. 276 shares bought. Total number of shares purchased plus recurring, 683. Average recurring investment cost per share, $84, because you've averaged with every single jump or fall of the market. You didn't care about the stock price. You just kept buying for 10 years. For $200 a month for 10 years with your initial $10,000 investment, you have earned $115,000. Let that sink in. $115,000. You have bought every dip, every rise you bought, and you averaged as you went along. Think about that as you go along. How does that $200 a month sound to you? If you just bought one stock a month for 10 years, your $10,000 investment is now worth $115,000. Guys, this is how you get rich. You get rich carefully. You get rich slowly. This is it. Just a heads up. 10 grand to 115. How does that car note sound to you now? $200. How great is this? You keep doing it for another 10 years. How much do you think this will go up? Probably $1 million, right? You just became a millionaire in 20 years. And that's only $200. Let that sink in. That's only $200 a month that you bought in stock. That's not including dividends, guys. That's not including dividends. Not including dividends. I'm going to share this on Facebook because people need to know this. So just a heads up. Okay, so that is the first thing. So I want you to understand dollars cost averaging. So every month you buy a stock, you're buying shares, you're just consistently buying as you go along. You don't care about the stock price because you're staying A, disciplined, and B, patient. Remember those two words, patience and discipline. Oh yeah, of course. So boring, unsexy. Well, that's going to make you money and that's going to make you rich. That's the key. That's the key, guys. That simple. So if you have any questions or you want to mess around with this a little further, check out buyupside.com. Great tool. Take a look at them. So let's go back to the Wisdom Tree High Dividend Fund. Looking at it here, this is paying 3% yield per year. Not exactly the best because I can get 5% on AT&T. I can get 5% on AT&T, guys. So there's no point of buying this because it's not paying enough yield. It's basically just above the 10-year note, which is paying 2.6%, and that's a government bond. That's basically AAA rated, guaranteed. So again, I would want a little more yield. That's why it's only 1 star. Here's what it holds. It holds AT&T, Exxon, Verizon, Chevron, Pfizer, Procter & Gamble, Wells Fargo, General Electric. General Electric sucks. And Philip Morris and Coca-Cola. These are companies that pay a consistent yield, high yields. They're always returning capital to shareholders. So again, if you're a dividend guy like me, you'd probably, well, I wouldn't buy this fund. But again, you kind of want to go shopping, guys. If you buy a new TV, you probably go on Consumer Reports. You probably look at reviews, YouTube, Amazon reviews, just to make sure. Do the same thing with your investments. This is your money. It is your responsibility to make sure what you're getting into, to what you're buying. You want to make sure what the heck my fund holds. That's it. So let's take a look at the mid-cap dividend fund. This looks like a 5-star fund. This is considered a 5-star fund by Wisdom Tree. This only pays 2.19%, but it has better growth. Let's look at the S&P in comparison. Better growth. Dividend is a little whatever. I mean, it's not great. Let's see what it holds. Targa, McGuire, Macy's, Tapestry, Kohl's, Gap, Darden, Baker Hughes, Whirlpool. So it's very heavy on retail. I wouldn't buy this, and I agree with the street. I would not buy this. Number one, I would run fast because we already know that Amazon's taken over retail, and the only other retail play we like, as we've told you many times, is Home Depot and Walmart. WMT HD. We're seeing the shift to online. I don't like Macy's, and I definitely don't like Kohl's, so I'm not going to buy this. Let's take a second to answer some questions. George Lovano, agree with you. People in Reits is key. Can you automatically invest X amount into stock? Yes, absolutely, George. Jorge, you can invest whatever you want, automatically reoccurring every month. Any broker does it. 15th, 1st of the month, 30th of the month, 25th of the month. Whenever you decide, you can do it. Mr. Pipton, when using dollar cost averaging, do you think it's better to buy monthly as opposed to waiting longer intervals to avoid commissions? Remember what I told you, commission-free ETFs. You can do this with commission-free ETFs, guys. Remember that. Commission-free ETFs. So you can buy commission-free. These ETFs that I'm showing you here, right here. I recommend monthly or biweekly. Mark, bullish enough on Square stock to keep on that monthly dollar investment as an example per se? Yes. But again, we're trying to stick to long-term wealth. That single stock, remember, single stock is more speculative. I just did the Apple comparison because it was just Apple. That was all. But yeah, I mean, long-term, yeah, absolutely. I love Square long-term. Do also ETFs pay dividends? Yes, Jorge, they do pay dividends. Remember, we just showed you right now the dividend-paying stock. The yield wasn't terrific, but it was there. They do pay a dividend. And of course, you always want to reinvest your dividends. Home Depot. Why Home Depot? John asks. Because you can't buy lumber on Amazon. Not yet, anyway. But I like Home Depot. It's one of my favorite stocks. Okay, so let's take a look at another ETF. Let's look now by sector. So trust materials. Looking around. Let's look at some commodity funds. How about that? Let's have a little fun. Let's see oil and gas. Let's say you're very bullish on oil and gas, and you say, man, I'm telling you, Carlos, oil is going to come back to $100 a barrel, $200 a barrel, whatever. FXN is probably what you want to play. And this is an ETF, commission-free. And look at this. Yeah, it's a little more volatile. Dividends paying 1.13%. This is a one-year chart. S&P 500 beats it. Look at the risk. A little higher. Return a little low. Maybe something I wouldn't personally invest in. But let's take a look. It's a 3-star fund. 1 year returns, not exactly sexy, not exactly great. Let's look at their holdings. SM Energy, Valero, Murphy Oil, Contra, QEP, Holy Frontier. Year to date, why is it up now? Oil's up, guys. $64 a barrel now. So again, is this going to last forever? We're not sure. Again, we are bullish personally on oil. I would not buy this. I would not buy this fund personally. Unless you're very bullish, I would not buy this fund. Let's take a look at, Kevin's asking about REITs. Okay, so let's take a look at different sectors. Let's see if I can find a REIT here. Retail ETF new. I know I saw REITs here in equity funds. Well, there's one, aggressive allocation. We may not see REITs here for commission free, but we definitely could see REITs on mutual funds. So let's take a look at this quick aggressive allocation, iShares, AOA, and then we're going to take a look at REITs. So that'll be the next one. Let's take a look here. This is a core aggressive allocation. This is 80, 70 to 85% equity. This is probably for somebody who's going to be a little more aggressive with their allocation, asset allocation in their funds. So definitely higher stocks. Above average return, higher risk, as we know, against the S&P 500, just below them in 1 year. Year to date up 20%. Pretty strong. This is what it holds. S&P 500, international, emerging markets. Again, if you're very bullish, this is probably a fund you want to be in right here. You're still going to get some dividend yield. Look at the performance. Take a look at it. And remember, guys, you can track this because this is the symbol, AOA. You can look at it. Yahoo Finance, you can look at Google Finance, CNBC. You type in AOA, it comes up. So look at the growth here. $10,000 to $16,000. But again, you're still below the S&P 500. S&P 500 basically doubled the money in 5 years. So again, we want to beat the baseline of inflation, but also beat the S&P 500 because the S&P 500 is basically SPY, which is the symbol, the S&P 500 index. So if I could just buy that, basically no commission, this one no commission as well, why buy an iShares aggressive allocation ETF where I could just buy the S&P 500? It's just the top 500 stocks in the market, S&P 500. Very simple. Again, if it can't beat the S&P 500, why would I want to buy it? As an example. So let's take a look at ETFs again. This is not commission free, by the way. These are just the ETF market center. So let's take a look at Reits. Let's take a look at Reits. Screener, excuse me. And emerging market, inflation protected bonds, life cycle standard, bear market ETF. So again, if you're short the market, you can always buy a bear market ETF. There's always ways to play the market. Waiting on this. Let's see categories. Oh, I just had real estate. Sorry about that. Let's go back. So remember, every broker has available access to ETFs and mutual funds. So let's take a look at real estate. Let's say, Carlos, man, I want to own some real estate, but man, I really don't want to deal with tenants. Okay, let's take a look at some ETFs that are real estate based. Let's click on the first one, Powershares Kbw Premium. So this is an ETF that is not commission free. You're going to pay a commission here, guys. Just a heads up. But look at the yield. The yield's very sexy here. 7.53. I like it. High risk, high reward. Hello. Let's look at the expense ratio. Very low. I like this one here, guys. KBWY. Take a look at it if you like real estate. Let's see compared to the S&P 500. Yeah, it's actually down compared to the S&P 500. So the S&P 500 in a year is up over 25%. And this mutual fund or ETF here is down nearly 10%. So there's a lot of ground to make up just to beat that. So it's a blend of small value, as you can see here, this little box. Let's take a look at what they own. Washington Prime Group, New Senior Investment Group, DDR, Global Net Lease. These are companies that are real estate heavy. Great news is that it pays a very solid dividend, 2.53. If you're looking for dividend like me, this is probably what you're going to buy. So let's look at performance. Let's look at the long-term performance here. In 5 years, you have turned 10,000 to over 16,000. I love it. Great equity growth in 5 years. Pretty solid. Pre-tax return of 7%. Okay, I'm okay with that. Look at the period here. 19% growth, 3-month period. Where's the 16? So again, you definitely want to see what you can tolerate, what you can handle. But hey, if you want to buy some real estate and get some real estate investment trust, you don't want to own property, but you like real estate, you like the money that comes in from rents. These are commercial real estate property holders. These are residential property holders. This is probably definitely for you. This could be something that'll be very well in your portfolio. I definitely love real estate. I don't own any real estate yet personally. But again, if you want to dip your toe in the water and get into real estate, this could be something for you. REIT, Real Estate Investment Trust, ETF. Get yourself in there, take a look at your portfolio, what you can take, what you can allocate, and looking further what you can handle as risk tolerance. Again, guys, what have I said before? Patience and discipline will build wealth. Good yield. I like this one here, KBWY. Take a look at it. If you like it, the only thing is that there's going to be a charge. It's not a free ETF. So let's take a look at categories. Again, let's see, Market Center on ETF. Let's take a second to answer any questions again here. I know we just talked about mutual funds, but again, this is just an overview to talk about wealth building and investments, and I really wanted to get into mutual funds because this is the way to build wealth slowly. And keep your heads up, guys. This is only the intro. We're going to start building this channel is going to be a private channel just for long-term investment clients who want to learn about long-term investing, mutual funds, how to build wealth, personal finance. I'll be here to help you every week. There will be a charge for it to be part of the group because only 50 can join this private channel. But again, we'll be answering questions directly to your portfolio and what assistance you may need down the line to build wealth. Let's go ahead and take some questions here. Please go ahead and type in any questions you may have. I want to give a quick shout out to all the 18 viewers right now that joined today. Awesome stuff. Thank you so much for joining. Any other questions, guys? So this one is free. Cost for subscribing? No, it's not, Mark. This will not be free. This one is free. This one is free. This one, Mark, is the free introduction to how we're going to do things here, how we're going to talk about ETFs, long-term growth and wealth, and how to build yourself, your nest egg, your portfolio to build wealth. Okay, so if you invest in ETF, do you earn the growth of an ETF and also dividends quarterly? Depends. Let's say the ETF does pay a dividend. Yes, you will get paid a dividend. It will be credited to your account. You will see a statement. It'll say dividend credit to your account depending on how much you own. So you can get both growth and dividend, but you're not going to get as much growth as you would at a non-dividend, like a tech ETF. So just a heads up. Any other questions? We're going to take another couple of minutes to see if anyone has any questions. You want to go ahead and mess around with the dollar cost averaging calculator again? That'd be fun, right? Let's go back and mess with it. Let's mess around with a dividend reinvestment calculator. Oh, my favorite. How about that? Dividend calculator investment. Dividend investment calculator. Hello. Reinvestment calculator. Let's see if we have any questions here. Do you use structured notes, market link CDs, or any type of annuities? Carl, no, I don't. No, I don't. Mr. Pipton, how do you find a good financial advisor? That's a really good question. If you want to take a look for a really good financial advisor, I would definitely look at the bigger companies like a Raymond James, Fidelity, those guys. That's probably your best bet. Or you can also check with the SEC and see what good financial advisor are out there, or FINRA, FINRA. Jorge, I'm not going to talk about what other businesses I have besides trading. This is about long-term investing. So let's take a look at our dividend reinvestment calculator. Let's start with 100 shares of AT&T that's trading at $38 a share. $38 a share, that's AT&T. Annual dividend's 5%. Dividend annual growth rate, let's be paltry and put 2%. They grow their dividend by 2%, which is very conservative. Stock price annual growth rate, let's say be conservative, 3%. Okay, so hear me out here, guys. This is the dividend reinvestment calculator. This is how dividends work. I'm going to show you now exactly how to build your wealth here. Here's another way to build your wealth. You're going to basically charge rent for stocks. So think of this stock as like apartment, and you're getting paid just to own it. Very fun stuff. So we bought 100 shares of AT&T at $38 a share. I don't know if it's exactly $38 a share. If you really want to check, let's go and take a look. Let's have a little fun and see. AT&T, $37.87, right? Keep the change, right? $37.87. Look at the dividend yield is 5.37%. I am a shareholder of AT&T. So annual dividend, it says $5. That's not correct. The annual dividend is $2. So let's put $2. And I thought it was percentage. Annual growth rate, let's just put 2%, which is very conservative, by the way. And stock price annual growth rate, very conservative, 3%. So this is very conservative, by the way. So again, look at the difference of reinvesting your dividend versus cashing out your dividend. So you have two options. You can either have your dividend reinvested into the stock, into your portfolio, which any broker will let you do, no problem. and there's one that you can get a check. A lot of older individuals that are retiring, they take their check, their dividend check, to live off of. Just a heads up. They're not going to live off 100 shares, obviously. So let's take a look here at the difference between reinvesting your dividend to not reinvesting your dividend. There's your difference. Total number $7,380, $340. Number of shares 100. Number of shares 162 with dividend reinvestment. Dividends paid $2,233 annualized return. 2% difference. You get $1,000 more just for reinvesting the dividend. But here's the difference here, guys. Here is the difference that's going to change your mind. This doesn't look like a lot. I know this doesn't look like a lot. But guess what? Taxes. Taxes. If you reinvest your dividends, you're not paying taxes on it. If you take your dividends, you're paying tax. So this is a lot less because Uncle Sam's going to want to take their cut. Now, you may want to check with your CPA on what your tax bracket is. But here, when you do dividend, you're definitely going to have a lot more because you are now not talking taxes. All you're doing is deferring it, but you're going to make a lot more than just calculating it and cashing it out. So speak to your CPA on what's best for you for tax-wise. But again, that is something that you want to talk about as well, and always weigh your taxes. Taxes are based on the state you live in and federal taxes on your income. So always, always be cognizant of that. So let's take a look back again on dollar cost averaging. Oh, dollar cost. Let's look at stock returns. Stock returns should be a fun one. Oh no, excuse me. Forget that one. How about this one? Compounding interest. Compounding interest is always fun. If you invest $10,000, 5% for 10 years, future value is $16,288. That's just verifying 5% per year. Now, if you make that 5% for 10 years, 16,000 goes to 26, 43, 70, 114. Obviously, 100 years is a lot. So again, these are the interest calculators. Remember, the more you put in, the more you'll get out. Just a heads up. And 5% is pretty weak. Okay, so any recommendations of programs that teach you about finance for investing and trading? The best thing about that, Mr. Pipton, you want to take a look at Investopedia. Investopedia is a really great source. Take a look at them. Investopedia.com. Jorge understands the wonder of compounding interest. Absolutely. It is a great thing. I love it. I love it. I love it. Don't forget, guys, buyupside.com is the website to mess around with the calculator. So much fun. Okay, so this is AT&T paying the 5% yield, $2 a year on annual dividend. Love it. 5% on dividend is great. This is why when it comes to dividends, when it comes to your phone bill, this is why they charge so much, to make sure we get our dividend. Okay, John, speaking on taxes, long-term wealth, do you recommend traditional Roth IRA where you put IRAs to grow, mutual funds, ETFs, or both? If you qualify for Roth IRA, absolutely yes. If you qualify. Roth IRA is not qualified for everybody. You have to be under a certain threshold of income in order to be available for Roth IRA. Roth IRA is post-tax dollars, meaning you've already paid tax on it once. You do not pay tax on withdrawals on that IRA, on the Roth IRA, which is great. It grows tax-free. When it comes to traditional, it grows tax-deferred. You will pay taxes. Roth you've already paid. Just a heads up. So if you can do a Roth, if you are under the threshold, yes, by all means, get in. All right, guys, so we're basically wrapping it up here. We talked about mutual funds, Reits, compounding, dollar cost averaging, very fun stuff, and dividend reinvesting. Look at the difference on exactly everything, how we went. This is just the first of many videos and live town halls we're going to do to help you grow your money. We're going to talk personal finance. We're going to talk retirement. We're going to talk wealth building. We're going to talk mutual funds. We're going to talk investing again, more and more with you in mind. It's going to be private. So again, it's a private chat. It's a private group where we're only going to talk to you about your money and help you out to grow your money. Not to do with trading, not to do with anything like that or crypto or any of that stuff. This is about you growing your money and being wealth building. Okay, so last couple of questions here before we end. Cookie Seed Cookies, starting as a youth investor with only $2,000 to work with, what do you recommend is the best move? ETFs or just hold on to it? Cookies, seed cookies. I would ask you, I need to know, is this emergency money? Is this investment money? What exactly you're trying to do? My number one thing I tell everybody, if you have less than $25,000, buy an SPY fund, S&P 500. Easy as this. Type in SPY, S&P 500 stock, right? SPY. If I can find it, let's search. SPY is the S&P Spider 500, right? Look at the expense ratio, 0.09. You get some dividends, but again, look at the growth you're going to get. And look what it holds. Apple, Microsoft, Amazon, Facebook, Berkshire Hathaway, Johnson & Johnson, Chase, ExxonMobil, Google. Can't beat that. Those are top-notch companies. They're blue-chip companies. Again, look at the portfolio they're holding. If you have less than $25,000, guys, stick it to an S&P 500 fund. Remember dollar cost averaging. $200 every month, $300 every month, and you will see your wealth build. And trust me, when you're doing dollar cost averaging, you want stocks to fall because guess what? When stocks fall, you're buying it at a discount. You already have your goal. You're disciplined. You're looking long term. You're patient. That's how you build wealth, guys. Remember that. That's how you build wealth. Look at the portfolio of the SPY. Look what it holds. Guys, it's that simple. No penny stocks, cookie seat. That's not building wealth. Jorge, do you need an account in Morningstar to look up ETFs? Yes and no. You don't need to. Open a TD Ameritrade account, guys, and you'll have access to what I'm looking at right here. And you also get Morningstar too. So, guys, that is wrapping it up for our town hall meeting, talking wealth building. Very, very fun stuff. I really, really hope you enjoyed this. It was only an hour long. I know we could have got to more, but I mean, how fun was that? I know when it comes to wealth building, guys, it's pretty boring. It's a little tedious. But again, you want to make sure you're patient and disciplined long term. That's the key to building wealth, is long-term patience and discipline. I've told you about dollar cost averaging, compounding interest, dividend reinvestment, ETFs, Reits, everything. We've done so much together. Super fun. Asset allocation. This is the key, guys. You do these things and you're disciplined and you're patient. I promise you, you will build wealth. You will build wealth and you will become wealthy. Now, again, how wealthy do you want to become is up to you. Mr. Pipton, last question. How much of your portfolio should you have in emerging markets? Again, that is up to you. Your age minus 100 is how much you should be conservative. The rest should be a little more aggressive. Emerging markets, depending on your age, I would say 15%. 15% sounds pretty good. If you're a little aggressive, 20% in emerging markets. Emerging markets, again, pays higher dividend. Higher growth, a little more risk. So again, it's really up to you on that teeter-totter seesaw exactly what you can handle. So again, so there you go, man. I appreciate you guys joining us. Guys, if you want to join our private channel, you need to email me, garcapital@gmail.com. Only 50 seats remain for private channel. I'm going to put that. Only 50 seats for private channel. Just a heads up. So again, it's only the first 50 that jump on. This is wealth building. This is personal finance. Okay? We're doing this every week, every month. Very fun stuff. It's going to be like a signal group, but again, it's for personal wealth building. Okay, it's with me personally. We do this every week. We're going to talk about your money and growing your money. It's going to be $100 a month. You can cancel anytime. Cancel anytime. If you want to join, email, subject line, private YouTube group on subject. Just a heads up. If you are interested, make sure to email me that. There's only 50 spots. Once that 50th spot is taken over, I cannot remove anyone else. Just a heads up. If you enjoyed this, thank you so much. Hit the like button once I put the recording up on YouTube. Again, guys, as always, thank you so much for taking the time out of your evening to spend with me. My name is Carlos Garcia. I'm the founder and CEO of GAR Capital. Have a great evening, guys. And again, this will be posted on YouTube to watch anytime you want. Anytime you want. Thanks again, guys. Have a really great evening. And we'll talk to you soon. I hope you join us. Thanks again, guys.